What's up, family? Andre here. On today's episode, we're going to talk about an organization that is hiding in plain sight. Many people don't understand the impact or the responsibility that the International Monetary Fund, or otherwise known as the IMF, has on the global economic stage. So today's episode, we're going to talk about who is the IMF, what do they do, how do they impact the global economy, and also how it can impact you and your money. But before we get started, to continue to help with that algorithm, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. The International Monetary Fund is a global organization with a lot of heavy influence on the global economic stage. They are very well known in terms of their policies across the world, but within the United States, they have a relatively low profile and many people aren't aware of who they are as well as the impact that they have on their finances. So let's first examine what is the International Monetary Fund. The International Monetary Fund is a global organization that promotes global economic growth, financial stability, as well as encourages international trade and promotes reducing poverty. The quotas of the member countries are a key determinant in the voting power of the IMF decisions. Votes comprise one vote of 100,000 of a SDR, which stands for Special Drawing Right of a quota plus basic votes. SDRS is an international monetary reserve currency that was created by the IMF. This is used as a supplement to the existing currency or monetary reserves of the member countries. There is a common misperception regarding the International Monetary Fund. Since it is a global organization, many people interpret that it is based in a foreign country. However, the International Monetary Fund is based in Washington, D.C. The organization is comprised of 189 member countries, each with a seat on the executive board based upon their proportion of financial importance. The IMF's mission, according to its website, is to foster global monetary cooperation, to be able to secure financial stability, facilitate international trade, promote high employment and economic stability, and reduce poverty around the world. In listening to that IMF mission statement, it probably sounds very familiar. If you've ever had a chance to read or listen to the Federal Reserve of the United States mission statements, they sound very similar. Go and check out my Federal Reserve video and you can see the similarities between the Federal Reserve and the IMF. The IMF was created in 1945 by the Bretton Woods Agreement, which attempted among member countries to encourage financial cooperation through a system of convertible currencies at fixed exchange rates. The International Monetary Fund oversaw and ran the system, but each member country could be able to adjust those rates up or down by 10%. But anything larger than 10% will require IMF permission. After World War II, many countries were in need of reconstruction due to the significant damage that was sustained during the World War. The IMF created a separate international bank solely designed for reconstruction and development, but in order to be able to participate in that bank, you had to be first a member of the original International Monetary Fund. In the 1970s, the Bretton Woods system collapsed. From that point forward, the International Monetary Fund promoted a system of floating exchange rates, which means it lets market forces determine the value of currencies from one to another. The IMF's primary activities in achieving their goals are focused in two areas: monitoring capacity building and lending. The IMF makes loans to countries that are experiencing financial distress to prevent an economic collapse or to mitigate financial stress. The IMF collects enormous amounts of data on national economies, international trade, and global economies in total. The IMF provides regularly updated economic forecasts at the national and international levels. This is published in the World Economic Outlook, which then accompanies lengthy discussions around global fiscal and monetary policies by many of the member countries and their global economy. The IMF provides technical assistance, training, and policy advice to member countries through its capacity building programs. These programs include specific training on data collection and analysis, which in turn feeds into the overarching goal of the International Monetary Fund, which includes monitoring of national and global economies. As I mentioned before, the IMF makes loans to countries that are experiencing severe economic distress to help prevent or mitigate a financial crisis. Member countries contribute to a pool within the International Monetary Fund that's based on a quota system. And the contributions that are contributed by the member countries can be very significant. In 2019, the member countries contributed to this pool $11.4 billion that will be able to fund the International Monetary Fund's activities for the next decade. The International Monetary Fund's loans and funds are typically conditional, meaning that they expect the recipients of those funds to make necessary reforms and changes to promote growth and their own financial stability. There are three standard types of loans that the IMF engages in with member countries to be able to promote global financial stability. And those three loans are: a standby agreement, otherwise known as a SBA, is a type of loan that offers short-term financing to its member countries. Typically, the payments are spread out anywhere between 12 to 24 months, but no longer than 36 months. The Extended Fund Facility is a midterm financing loan program which is offered to member countries, which typically lasts between 4 and 10 years. The EFF, as it is called, aims to promote structural reforms that potentially led to the financial crisis within a member country. This is done through a series of tax and financial reforms, as well as privatization of public enterprises. The third loan program through the IMF is the Poverty Reduction and Growth Facility, otherwise known as the PRGF, and is just like it sounds. It is targeted to help reduce poverty within the member countries and lay the foundation for promoting financial growth and stability within that economy. These loans are typically offered at a very low interest rate and for extended payment terms to give these economies time to make the necessary reforms to be able to encourage growth and financial stability. The IMF offers technical assistance to transitional economies that are transitioning, say, from a centrally funded or communist type of economy to a more market-run capitalist type of economy. All of the goals and objectives of the International Monetary Fund aim to create growth and financial stability within the member countries, and they want many of their objectives and their regulations to be accepted by the local population. But it's important to keep in mind that the International Monetary Fund is not an aid agency. They are a global monetary fund, and the loans that are dispersed to member countries are expected to be paid back. And there are conditions on those funding that those programs that are dictated by the International Monetary Fund are implemented as a condition of their funding. Countries that are under IMF programming are typically developing, transitional, and emerging market economies, or countries that are emerging from or through a financial crisis. Here are the key takeaways to the International Monetary Fund. The IMF's mission is to promote global stability and financial growth, promote international trade, and reduce poverty around the world. Originally created in 1945 as a part of the Bretton Woods Agreement, it was created to foster global financial cooperation through a system of convertible currencies that were issued at fixed exchange rates. Contrary to popular belief, and even by its name, the International Monetary Fund is based in the United States in Washington, D.C. It's important to have a broader perspective of the global economy and how an organization like the International Monetary Fund fits into that role. These individual organizations tend to be looked at as silo organizations, whether that's the Federal Reserve, the International Monetary Fund, or the World Bank. But make no mistake about it, that these individual entities are a part of a framework for a global financial system. We are no longer siloed into our own part of the world. We're a part of a global financial system, and these individual entities set fiscal and monetary policies for their member countries, but also that can have influence and effects for other member countries around the world. And that is it. Hopefully now you have a better understanding of the International Monetary Fund, what it is, how it works, how it has an impact on the global and fiscal economies across the world, and how it can impact you and your money. But before you go, please, to help with this algorithm on the YouTube channel, please don't forget to smash that like button, hit the subscriber button, as well as the bell next to it to get updated weekly content. Thank you for tuning in.